Good day, fellow investors. Facebook is a stock that we are covering publicly on this channel, so let's discuss the last earnings, the developments, the business, the valuation, and then the investment thesis. Also, Pabri's take that Facebook is an easy double in the next 2-3 years. So, if we look at the stock, of course, yesterday, Thursday, I'm filming this Friday morning, 6th of May, the stock has crashed alongside the market, but if we look at what has been going on over the last year, we are significantly down, almost 50%, as we had the first decline in subscribers here, and then a choppy ride with a boom. I have seen many headlines, boom, Facebook stock up 25%, but keep in mind it is where it was a month ago, so it is still below 10%, 15% below where it was a month ago. So don't get too exuberant on these jumps, always look at the bigger picture, and the bigger picture is that, okay, it is up, but not that much up over the last 5 years. Of course, over the long term, it did really well up till here, and now it's still good, it still grows. The number we have to keep in mind here for valuation is 563 billion, which is the market capitalization, and the price earnings ratio, let's round it up to 16. Let's discuss the results. So what I am looking at is that at the first time really in history there has been no growth in revenue advertising, also a small decline in Europe, and what saved the picture is Asia Pacific and the rest of the world, where they are still growing. But this is what I'm looking and I'm thinking, you have increased the number of ads significantly, but it seems that people are using Facebook less due to competition. That's at least my thesis. Of course, the management says that Reels are not yet monetized, the economy, war in Ukraine, Forex, Apple hit. But I'm thinking, and not just a thesis, is, let's say, more of a risk. Is Facebook correct here, or it's more structural? And that's the risk reward you're taking when investing in Facebook. You're taking the bet that it's temporary headwinds versus a structural issue due to competition and due to you spending more time on YouTube, subscribe and smash that like button, versus Facebook and other things. And that's something that I'm sensing and putting into risk-reward perspective, and that's why my thesis for Facebook is changing a little bit. And then expenses are jumping. Zuckerberg said that these expenses will go lower in 2023, which will then allow for more cash flows. But if I look at earnings, also earnings are 20% down from the same quarter of the previous year. For now, the trailing 12 months earnings are 13.22, which reflects the P ratio of 16. But if I decline those at the current rate, then we are looking at earnings per share of 10 to 11 for 2022, which then leads to a market P ratio of 20, which is not that cheap. Even 16 is not that cheap, especially if earnings decline. And then if we discuss the conference call, let me just share something that is very important. 85% of managers in the conference calls I listened to this quarter mentioned the war. Of course, it's a terrible situation and it is certainly painful, but this is just an excuse. It's not the war that's impacting business. It's consumption, it's spending, it's inflation, and that's something that you have to be very careful on when you listen to these conference calls. Further on the conference call, second quarter revenue, really they forecast stagnation, expenses a little bit low, and capital expenses really high, 29 to 34 billion. And the question is, when will they lower these expenses? And then on the metaverse, this is the key comment. You have to understand that this is a play for the 2030s, so that 20 billion of the 30 billion spent is for the metaverse and for the 2030 play. So that's very difficult to accept and let's say see forward. I receive a lot of emails, Sven, they will change the world, they will this, they will this. Yes, but I'm a value investor. I don't invest in changing the world. I invest in current things that work no matter what, no matter where the world goes. And that's also the thesis for Facebook, that we have growth in advertisement for the longer term, and then on top of it, the option of the metaverse where Zuckerberg is betting everything on. And now you have to see, okay, how does that risk reward compare to the price, and how does that fit your portfolio? We are all different, so you can enjoy what they are doing there with the metaverse and everything, but let's go for the valuation. Of course, our table, this is the free one. I have just updated Facebook. You can download it by clicking in the link in the description below, and I have changed the earnings here to, let's say, 11, and then let's say growth ahead of 6% and 5%. And if I expect a 10% discount rate, a 10% investment return, and Facebook has a P ratio of 20, which is higher than the current one, then the intrinsic value is 137, still much below the current stock price of 200. So yes, for the current situation to be fairly valued, you need a P ratio of 25 and 10% growth and 7% and 10% growth, and then we are fairly valued. If the temporary headwinds are just that, temporary, then they will likely continue to grow and everything will be fine, and this is the thesis where you can make 10% per year. But if the growth rate is slower and then the terminal multiple also declines, then it can get very, very ugly if there are more headwinds and people use Facebook less. This is the risk and reward. Of course, you can check also the links to other research and valuations. You can play around, test yourself, and see what best fits your portfolio. And now we have Monish Pabrai, that I've looked at this video from Brandon that really summarized it well, and they say that Facebook is an easy double in the next 2 to 3 years because the valuation, the P ratio is 10, should be 20, the business will grow, advertising, the core and everything. And yes, that is very, very possible, but I'm also thinking, okay, what's the risk there? The advertising can go down, as we have seen, and that's always, will you start using something else? TikTok, this and that. There is so much competition for your eyes. You have so many options, and you are not glued to Facebook that much anymore. And there are so many new options coming, entertainment, whatever forms. So I'm thinking, perhaps yes or not, but it is about customer preferences, and those can change very abruptly, very often. So it's a risk I'm not willing to take at this price, even if it might double. So I would say Facebook, yes, can be a 2x or 3x in 2 to 5 years, but can also be a half x in the next 2-3 years. If that, I don't know, I'm working in the digital world, I'm looking at that Facebook, and I'm feeling that it might get ugly. So it's just a risk that I don't want to take for the long term or with a significant part of my portfolio. So I would disagree with Pabrai that's an easy double. Nothing is never an easy double. So that's my take. I hope you enjoyed this. Just share my opinion. I'm looking forward to your comments. I know there will be many saying how I'm wrong, but I don't care whether I'm wrong or right. I'm just looking at the reward, at the risk, and whether it fits me. So the key is that you see, okay, this is the possible reward, this is the risk, I think the chances are this or that, we'll all be different on that, and see how it fits you. I have other options, and that's what I do. Thanks for watching, see you in the next video.